A very good morning, friends. So I hope you're all doing well. And today, embarks the journey on, I would say, plethora of standards, which is on consolidation. This is another important topic. We finished our inputs on financial instruments. That is a very important pillar of Indian accounting standards, as well as very important from the examination point of view as well. Now begins the journey on the standards which are related to consolidation, and it's not one, but there is more than one standard which deals with this particular aspect of consolidation. So as usual, I would of course, again request and insist you that what is required is a cumulative revision based on the coverage. Because we'll be starting with, as you can see at the back of my screen, chapter number 12, that talks about business combinations, and that is Ind AS 103. But before we start with Ind AS 103, I would just like to connect some dots. Connect some dots in the sense that you need to be first of all clear, when does which standard trigger? Because consolidation has got a lot of standards. So first we're going to do some grounding work in terms of understanding that in which permutations and combinations which standard applies. Because if you apparently ask me, which standards trigger in terms of consolidation, I would say it's Ind AS 103, it is Ind AS 110, it is Ind AS 111, it is Ind AS 28. I would also add the element of Ind AS 27, which talks of separate financial statements, not exactly in terms of consolidation. So typically we've got, 5 standards which are there, but deals with the aspect of, you can say, consolidation, and I would say the allied standards. So I think before we start, I need to first of all give you a very basic exposure, understanding that which standard triggers in which circumstance. Because I think this is one thing which everybody needs to be very clear on. Because unless we know that in which combination which standard is triggering, we do not get the conceptual clarity in terms of the things. So let's begin a journey. So let's, I think, first of all, introduce you the application, the scope of these particular standards. So for this, I'm going to make your life simple, and I'm going to give you again a step-by-step model in terms of deciding which standard triggers in which case. And I'm going to give you a 3-step model which will decide the agenda. Now, before I give you a 3-step model, let me just give you something at the background. So, as I give you step-by-step approach, there is one particular input example which goes at the back of your mind. So let me, I think, first introduce you to a very basic input. Let's say, for example, there is a company A Limited, and let's say, for example, there is another company that is B Limited. Now, A Limited buys something from B. Mind the words, I'm using the words very carefully. I said, let's consider A Limited buys something from B. I did not say that A gets a control over B. No, I never said that. I said A acquires something from B. Now, in this particular case, when A acquires something from B, I would say, let me put across, a few questions. So I'll first give you a basic framework of the 3-step model. So what I'm going to do, I'm going to first of all put across a question that what did he buy? So the first thing which I'm going to, put across is what did he buy? So I'm going to first put a question, what did A buy? Did he buy a single asset, or did he buy a group of assets? If he buys a single asset, the concept of consolidation can never trigger. It is only when you say that, yes, he bought a group of assets, then the standards on consolidation could trigger. I did not say that it will trigger. So I think the first and the foremost important question which you need to put across is, what did A acquire? So if you say he acquired an individual asset, the question of consolidation does not arise. But if you say he acquired a group of assets, then I go to the step number 2 to evaluate and decide, is that group of assets supposed to be a business or not? So once you say that it is acquired a group of assets, then the next question to decide is that group of assets supposed to be a business? Now, there are parameters which are given in Ind AS 103 itself, which tells you that whether it is a business or not. So we will not decide on any ad hoc basis whether it's a business or not. So there are certain tests which are given in Ind AS 103. Now these tests are called, one is called an optional concentration test. Just putting some things into your mind. So one is called an optional concentration test and the other one is called a three-element test, which I call IPO. Input, process and output, that's the three-element test. So with the help of these tests, we will be able to understand and evaluate whether the group of asset acquired is a business or not. And if it is not a business, trust me, consolidation standards can again not trigger. It is only if you reach a conclusion that the group of asset is a business, then only I'm proceeding towards the consolidation standard. And then we go to the step number 3 to decide that did A get a control over the business of B or not. And when you look at the concept of control, the control basically means that you are able to get on a very apparent front more than a 50% voting power. But let me tell you, the assessment of control is based on Ind AS 110, which is not a rule-based assessment. The concept of control assessment as per Ind AS 110 is supposed to be a principle-based assessment. So we'll see later when we come to Ind AS 110 that there may be a control even if you've got less than 50% voting power in a company. And there may not be a control even if you acquire more than 50% voting power. But I think for the time being, we are considering that, okay, let's assume that if you get more than 50% voting power in a company, you attain a control. So the 3 checkpoints, or you can say the 3-step model, before you reach a conclusion of applying the consolidation standard, the focus is that what did you buy? You should say that we bought a group of assets. Unless you say that it is a group of assets, we will not be able to zero down and say that we are proceeding towards consolidation. So the first and the foremost important thing is A acquires multiple assets. Now, when I say group of assets, it does not mean there is just assets. It can be assets with, without liabilities. So what is important is multiple assets and liabilities acquired. And the second focus is, yes, it should be a business. And the third focus is, yes, you got a control, then the consolidation standards could trigger. So I think I made myself very clear on my initial thought process that you need to put across 3 inputs to yourself. I've just given you the framework. I will work upon this 3-step model in detail. But I've just given you some basic framework of thoughts that you first decide, what did you acquire? It has to be group of assets. Is that a business? It should be. Did you get a control? Yes. If yes, then the consolidation standards will trigger. I hope, friends, so far so good. Just giving you the basic framework. I hope you got the basic thought process of deciding. Now let's deep dive in terms of these 3 steps one by one. Okay, that's perfect indeed. So now we are ready to deep dive into this particular thing. Good morning, sir. I almost skipped amalgamation chapter in intermediate and no exposure to it. Would I be able to understand these Ind AS? Undoubtedly, yes. You know, if you compare Accounting Standard 14 with Ind AS 103, no comparison. I'm not scaring you, but there's no comparison at all because Ind AS 103, stands at a very different level and different pedestal altogether. So I think even if you have a knowledge on AS 14 or not, would not make any difference to me. So very basic input is good enough, not required as such. Okay. So now let's proceed with the inputs. So I'm now going to formally introduce you to, you can say, the 3-step model. So I will now introduce you to the 3-step model, how we will decide the various standards. Now let me tell you, as I'm now going to proceed with the 3-step model, I'm going to give you a lot of standard numbers. So the idea right now is to give you an exposure that, okay, in this case, this standard applies. In this case, this standard applies. So let's go with the input. So I'm first looking at step number 1. The question in the background, of course, remains. The question in the background, of course, would remain. You need to continuously think of this case. A approaches B. So A approaches B. So in this particular case now, the first question which I'm going to put across is, what did A Limited acquire? So the first question I'm going to put across is, what did A Limited acquire? So in this particular case, the answer would be individual asset, group of assets. So when you come to the conclusion, what did A acquire? My answer would be, he acquired, let's say, an individual asset. He acquired, let's say, an individual asset, or we can say he acquired a group of assets. He acquired, let's say, a group of assets. Now, when I say he acquired an individual asset, I'll put another question in step number 1. Is that tangible or is that intangible? And the focus is on the non-current asset. The focus is on the non-current asset. So let's say he acquired an individual asset which is non-current in asset in nature. I will say, okay, let me identify, was that tangible in nature or was that intangible in nature? So we're going to put across a question and ask ourselves, did he acquire an individual asset which is tangible or is it intangible in nature? Now, let me ask you, since you've done a couple of standards earlier, so when you say that you acquired an individual asset which is non-current and it is tangible in nature, would you like to tell me which standard would trigger? If it is non-current, tangible asset in nature, then which Ind AS is going to trigger in this case? Wonderful indeed. So this is going to be Ind AS 16, or maybe I can say Ind AS 40, depending upon whether it's a PPE or it's an investment property. Good. And if you say that it is intangible, then I think, sure, you can again tell me the standard number. So non-current asset, if it is tangible, it's PPE or IP. And if it is intangible, it becomes Ind AS 38. So I think that's what the applicable standards is going to be. So indirectly, of course, when you study the asset-related standards, you automatically cover all this particular portion. In this particular case, Ind AS 103 or consolidation standards will not trigger. And if you say that we acquired a group of assets, then it's time to go to the step number 2, as simple and as straight indeed. I don't see that there will be any challenge in terms of step 1 because the focus is only to decide what did A acquire. If it is individual asset, tangible, intangible, 16, 38, 40, and if it is supposed to be group of assets, step number 2. Now let's go to the step number 2. Now, in terms of the step number 2, our focus is now that this group of asset, our focus is now that is this group of assets a business or not? So is the group of assets, so we will put across a question that is the group of assets a business? So now the agenda is in terms of deciding that is the group of asset supposed to be a business or not. So we need to evaluate, is the group of assets supposed to be a business? And when you evaluate that the group of asset is a business, there are certain tests which are given. So I think let me just add on out here. So we will evaluate this based on Ind AS 103. That's called business combination. The name of the standard is called business combination, and that's a focus right now. So whether it's a business or not, you will evaluate this based on Ind AS 103. Now, I'm just giving you the name of the test. How these tests are applied, we'll see that in detail very shortly. So I'm just going to give you some basic inputs at this particular stage. So when you say evaluate this is a business or not, so there are a total of 2 tests which are given in Ind AS 103. The first test is called an optional. The first test is called an optional concentration test. The first test is called an optional concentration test, and the second test is called the three-element test. The three-element test is also called, what I call it as IPO test. I call it as an IPO test. It's nowhere written in the standard that it's called an IPO test, but I prefer to call it as an IPO test. Input, process, output. The three elements of business are input, process, output. So we will apply these two tests, and after applying these tests, we will be able to decide whether it's a business or not. Now, we are not looking at these tests at the moment. So as far as the discussion of these tests is concerned, so we'll be coming back to the discussions on these tests, not at the moment. So as of now, I'm just making a mention that we will come back to these tests. So we will discuss later. So we will discuss these tests today itself, but discuss them later. How is the option concentration test applied? How is the three-element or the IPO test applied in order to reach a conclusion that is it a business or not? Now, once you apply the inputs, once you apply these particular tests, then the answer in this particular case is the group of assets a business? The answer, let's say, is a yes, or the answer, let's say, is a no. Now, if your answer is a no, consolidation standards cannot trigger. Now, please hear me carefully, because you can be tested on this no with a very simple little question as well. So if the answer I say is a no, the group of asset is not a business, this means that you've acquired certain assets by making a consolidated consideration. You approached a person, a supplier, bought certain assets together and paid a consolidated consideration. So in this particular case, what we need to do, we need to split the consolidated amount. We need to split this consolidated amount between various assets. So we need to split this between various assets. So in this particular case, what we're required to do, we need to split the consolidated amount between various assets in the ratio of fair value. So basically, in this case, we will say that you approached a particular supplier and he gave you multiple assets and you paid him a consolidated amount for all those assets put together. So what I need to do in this particular case, the consolidated amount is to be divided between the various assets in the ratio of fair value. And once you've done that, trust me, thereafter, Ind AS 16, 40 or 38 would apply. Because if you divide the consideration between the various assets in this particular case, then it is simply dividing. Then it is simply applying the other standards. So let me also make a mention out here. So once you've done this, then we can say thereafter, in this case, Ind AS 16 or Ind AS 40 or Ind AS 38 will apply. Depending it is tangible or intangible in nature, therefore these particular standards would trigger. Next, if you say yes, then it's time to go to the step number 3. If you say the group of asset is supposed to be a business, then it's time to go to the step number 3. So I guess apart from the concept of applying these two tests, how does an optional test apply? How does an IPO test apply? No worries, we'll take care of that later. But I think you got the thought process clear. That the group of asset needs to be a business before I can proceed to my step number 3. So far so good. I don't think so. There will be challenge on step 2, except for the 2 tests to be seen later. Let's go ahead. Then I come to the step number 3. We are going slow. We are going on a very systematic manner so that you are able to get a grip on this standard. So will the intensity of the standard also increase slowly and steadily? Of course, yes. Today, you may not feel that the intensity might be very high, but the intensity will definitely increase. So what you need to do is the same exercise. cumulative revision. After the first class, revise that. After the 2 classes, revise the first and second. After the 3 classes, revise the first, second, and the third. Cumulative revisions required. Now, coming back to the agenda in terms of step 3, now we will say, did A Limited get control? Did A Limited get control over the business of B Limited? So we already decided that it is a group of asset is a business. So now the focus in this particular case is to decide, did A Limited get a control? The focus is, did he get a control over the business of B Limited? Control, again, just to tell you, is going to be assessed on the basis of Ind AS 110. Like business is assessed on the basis of 103. The control is assessed on the basis of Ind AS 110. So in this particular case, when you say control, we can say the control, this is an assessment. This is an assessment based on Ind AS 110. So this is an assessment which is based on Ind AS 110, and the name of the Ind AS is CFS, Consolidated Financial Statements. So the control assessment will be done on the basis of Ind AS 110 for the time being. I said for the time being. So let me, I think, put this across as well, lest there is any confusion. So we are saying for the time being, we are considering that control is when you get more than 50% voting power in a company. So if you're able to prove that A gets more than 50% voting power in B, I would say A gets a control over B. Simple. But let me tell you that this is not the real picture, because control assessment, because I think it's important to tell you that control assessment as per Ind AS 110, the control assessment as per Ind AS 110 is not rule-based. It is not supposed to be rule-based, but principle-based. But it is principle-based. So this is what we need to keep in mind. So how does the real assessment takes place? That we'll understand when we come to Ind AS 110. So giving you the thought process, that for the time being, we're considering that you get more than 50% voting power, you get a control. But the real test is, Ind AS 110 is not a rule-based assessment, but is a principle-based assessment. As I said earlier, you get more than 50%, you may still not get a control. You get less than 50%, you may still get a control. So control is purely a principle-based assessment as per Ind AS 110. Okay, now once you decide that did we get a control, so the answer in this case would be either a yes or a no. So either you say yes, we got a control, or you say no, we did not get a control. Now let's give you something more interesting at this stage. I know early in the morning you would have got so much permutation combinations. Don't worry, we'll connect the dots also very slowly. So if you say the answer is a yes, then there are certain interesting standards which would apply. In this case, 3 standards will trigger. So if you say yes, 3 standards will trigger. One is Ind AS 103, which is on a business combination. One is Ind AS 27, separate financial statements. So this is business combination, and this is separate financial statements. And there is going to be Ind AS 110, which is consolidated financial statements. Now, let me explain this a bit. When you say that yes, A acquired a control over the business of B, I said 3 standards would apply. Ind AS 103, now mind this carefully, Ind AS 103 is going to apply once only. Ind AS 103 will apply once only. So it's going to apply only on the date of acquisition. It is going to apply on the date when you get a control over the company. So Ind AS 103 is going to apply only once. And then, since A gets a control over the business of B, A will be required to make every year. A will be required to make every year two financial statements. One is a separate financial statements and one is a consolidated financial statements, because A gets a control over B, so B becomes its subsidiary. And if B becomes a subsidiary, then A is required to present its own financial statements, that is separate financial statements, in accordance with Ind AS 27. And A gets a control, that means B is the subsidiary. He needs to also consolidate the results as per Ind AS 110. So every year A will be required to present two financials, separate 27, consolidation 110. So we can put something like this, that this Ind AS 103 is going to apply only once. This standard will apply only once, and that is on date of acquisition. It's going to apply only once, that is on the date of acquisition. But as far as the other two standards are concerned, this will apply every year. This will apply every year, because you will be required to present a separate and a consolidated financial statements year by year. Okay, so that means if you say a yes, there are three standards applying. Ind AS 103, which applies once, Ind AS 27, year by year, separate financials, and Ind AS 110, consolidation year by year. Okay, now let's come to the other point. If you say no, let me expand this further. Don't worry, I'll consolidate all these inputs. I know we started with a bang, where I've given you a lot of data through the three-step model. So no worry, but we'll just connect the dots. You need to be very clear, crystal clear, in which combinations, which standards will trigger. Now let's, expand that no. Let's expand. If you say no, there is no control acquired. So if you say no, there is no control acquired, I need to put some questions in the sequence. If you say no, I need to put some questions in a sequence. So we will apply certain questions in a sequence. We're going to put across a few questions in the sequence in which I'm giving you. I will say, okay, if A did not get a control, maybe he got a joint control. If no, then maybe he got a significant influence. If no, then maybe he's merely a passive investor. So you need to evaluate things on a step-by-step basis. So we will say that, okay, did A get a joint control? You'll say, did A get a joint control? And when you say, did he get a joint control, the answer could be a yes, or the answer could be a no. So when you say, did he get a joint control, the answer could be a yes, or the answer could be a no. If the answer is a no, I will say, okay, maybe he's got a significant influence. Maybe he's got a significant influence. Now, in this particular case, as I said, you need to apply these questions in a sequential manner. If there is no joint control, then you will say, okay, maybe he got a significant influence. And here again, the answer would be a yes or a no. So I will say, yes, he's got a significant influence, or I'll say, no, he's got no significant influence. Now, if you say, yes, he's got a significant influence, we'll see. But if you say, no, he's got no significant influence, then we will see maybe he's purely a passive investor. Maybe he's just a passive investor in that case. So in this case, you will say that, is he a passive investor? And the answer, of course, in this case has to be yes. Because if there is no control, there is no joint control, there is no significant influence, you're definitely a passive investor. So the answer in this case cannot be no. The answer in this case has to be a yes by default. Now let's see which standards will trigger When you say there is a joint control, or when you say there is a significant influence, or when you say it is supposed to be a case of passive investor. So let's give you some standards now based on these three yes. If you say that there is a joint control, before that, let me also tell you, the assessment of a joint control is based on IFRS 11, I mean Ind AS 111. And the assessment of a significant influence is based on Ind AS 28. So we can say the assessment of the joint control. How do you assess the joint control? So the assessment of a joint control is based on Ind AS 111. Similarly, the significant influence, you can say the assessment. How do you assess that there is a significant influence is again based on Ind AS 28, which we will all study later. So whether there is a joint control or not, how do you assess that? Whether there is a significant influence is decided by the relevant standards. And if you say a yes, in this case, two standards will trigger. One is Ind AS 27, which you have just seen, separate financial statements. And one is Ind AS 111, that's called joint arrangements. So if you say that there is a joint control, then two standards will trigger. One is Ind AS 27, separate financial statements every year, and the consolidated financial statements as per Ind AS 111. The reason is, depending upon the relationship, the kind of standard apply will change. If you get a control, the consolidation is 110. If you get a joint control, the consolidation is 111. So depending upon the relationship, the technique of consolidation will undergo a change. It's like, you meet people and you might address your friends differently. You might address your elders differently. You might address people who might be younger to your age in a different manner. So in any case, depending upon the relationship, the way you greet people also undergoes a change. So therefore, the joint control will lead to a different standard altogether. Now, if you say there is a significant influence, so we would apply Ind AS 27, that is separate financial statements every year again. And in this case, the consolidation will take place as per Ind AS 28, which talks about associates and joint ventures. It talks about associate as well as joint ventures. That's right, Ayush, you very well said that. So when you say finally reach a conclusion, no control, no joint control, no significant influence, you're a passive investor, then in this particular case, Ind AS 32 and 109 on financial instruments will apply. And that you've already done. Because when you say there is a control or a joint control or a significant influence, it is resulting in related party relationship. And when you say it is a passive investor, it results in an unrelated party relationship. So what is also important in this case is a joint control or a significant influence is resulting in a related party relationship. And if it is a case of a passive investor, it becomes a case of an unrelated party investment. It's an unrelated party relationship in this case. Let me also pinpoint that even if you say that there is a control, even when you say, yes, there is a control, so even in this case, it is a related party relationship again. So the moment you say it's a control or a joint control or a significant influence, it's related party. Now you must be thinking, sir, this introduction seems to be quite heavy in nature and there are so many standards applying. Can you just consolidate the inputs in a single go? Of course, I'll do that. This clarifications which I've given you is only going to help you that in a given situation, which standards will trigger. So once we're working on these standards individually, we are very clear on our thoughts. Right, friends, so far so good. Did you get the input so far? All good, ahead to go, I guess. Wonderful indeed. So that's great. Now, let me, I think, just connect the dots quickly before we proceed further. So let's, I think, consolidate the three-step. I'm just going to make a walkthrough. Just, bind these things in the back of the mind. It looks heavy, but trust me, it's not heavy. Once you know in which combination which standard will apply, it's easy. It's easy. So as I said, when you're looking at the concept of consolidation, I think you need to first of all decide that A acquires something from B. So I will put a question to A, what did you acquire? So the very first question which you need to put across to A Limited is, what did A Limited acquire? If he acquires an individual asset, then depending it is tangible or intangible, assuming it's non-current asset. So if he acquires an individual asset which is non-current, I would say if it is tangible, 16 PPE or investment property as the case may be. And if it is intangible, then it is Ind AS 38. So that means if it is individual asset, non-current in nature, consolidation standards do not trigger. And if you say it is a group of assets, then you go to the step number 2. Now you need to zero down that this group of assets without liabilities, is it a business or not? And in order to evaluate whether it's a business or not, we are given two kinds of tests in Ind AS 103. One is called the optional concentration test. Our next agenda of discussion will be to understand this optional concentration test. And there is another test which is called a 3-element test, which I call as IPO. IPO represents the 3 elements of a business: input, process, as well as output. So with the help of these two tests, we will be able to decide whether it's a business or not. If you say it's a business, you go to step 3. But if you say it's not a business, it's like, you made a consolidated payment, acquiring multiple assets together. So basically, you need to divide that consideration in the ratio of fair values. And once you have segregated the fair value, the total considerations between various assets, then again, you apply 16, 38, 40 as the case may be. And finally, in step number 3, once you say, yes, it's a group of assets, you need to see, did we get a control or not? And control is based on 110, not rule-based, but principle-based. But as of now, we are assuming that if you get more than 50% stake, we will assume, yes, you got a control. But otherwise, control is subjective. Control is not something which is, percentage-based criteria. So if you say, yes, we acquired a control, 3 standards would apply. 103 applies only once on the acquisition date, and every year Ind AS 27, making a separate financials, and B becomes your subsidiary. When A gets a control over B, B becomes a subsidiary, so consolidation as per 110. If you say, no, I did not acquire a control, then you need to apply a sequential joint control assessed on 111, significant influence assessed on Ind AS 28, and if neither of the two, it's an unrelated party investments, financial instrument standards would trigger. Where you take those equity investments at FPTPL or FPTOCI NR. If you say there is a joint control, then there are 2 standards, 27 and 111 every year. Separate financials as per 27, consolidation as per 111. Significant influence, 2 standards, 27 separate, and Ind AS 28 for consolidation, which is for associate and JVs. And if it is a passive investor, no consolidation, only investments will appear in the balance sheet. I hope, friends, I am crystal clear on my thoughts in terms of which permutation combination with standards apply. Now I need to work upon the 2 tests of business, control assessments and all that will be taken care in the relevant standards. So far, so good. Are we connected with all the dots right now? Yes or no? Any questions coming to your mind so far? Good to go ahead, I guess. Clear? Wonderful indeed. Okay. So now let's come back on the step number 2, deciding it's a business or not. So I'll start with a very simple flavor. But as I'm going to proceed, I'll need to give you some important thoughts as well. Okay, let's, I think, come back now on the agenda. I'm now going to give you insights in deciding the business. So we are now working on the parameters to decide, is it a business or not? So we want to now decide what are the parameters given in Ind AS 103 to decide it's a business or not. So I'm going to spend some good time, first of all, understanding this three-step very clear, because unless you know that a given standard triggers, we can't appreciate the accounting which is given in that standard. Okay. So as I said, to decide whether it's a business or not, we need to work upon Ind AS 103. So Ind AS 103 will decide whether it's a business or not. Now watch this carefully. Watch this carefully. As I said, there are two tests which are given in the standard. So there are two tests which are given in the standard. One test is called optional concentration test. One test is called optional concentration test, as the word itself is indicating that this is optional. As the word itself is indicating that this is optional concentration test. And the second one, as we said, is called the three-element test. It's called the three-element test, or what I said, I prefer to call this as IPO test, input, process, and output test. So these are the two tests. Now, watch this carefully. Now, as far as the concentration test is concerned, it is a matter of choice for a company to apply this test or not. I may refuse to apply this test. I've got the full power to refuse and say, I'm not applying this test. Let's not get into what a concentration test is. We will see the nitty-gritties of what is a concentration test, but the company may decide that yes, I'm applying this test. It decides to apply, or it says, no, I will not apply, because it is optional in nature. Since it is optional in nature, I may decide that I don't want to apply this test. If you do not apply this test, then applying the three-element test is mandatory. A company says, I'm not applying this concentration test. I'll say, okay, then you apply the three-element test on a mandatory basis to decide it's a business or not. Okay, now when you apply this test, the possibilities are that you either pass the test or you fail the test. How do you apply the test? We'll see. But let's say if you pass the test, or let's say if you fail the test. If you apply the concentration test and you pass the test, it is not a business decided. And you cannot apply the three-element test then. So if you pass the test, we have decided that it is not a business. In this case, we have decided it is not a business, and we should also be considering that three-element test cannot apply. Then in this particular case, the three-element test cannot be applied. So if you choose to apply the concentration test and you pass that particular test, you cannot apply the three-element test. You've decided it's not a business, done. Now, if you fail this particular test, then again, in this case, you need to mandatorily apply the IPO test. So I think get the dots connected very well. So we said there are three courses of actions. If you want to see this, there are three courses of action. I say I'm not applying the concentration test. Okay, apply the IPO test. I applied the concentration test and I passed. It's not a business. No further actions to be taken. You can't apply the three-element test. You applied a concentration test and you failed that test. Now apply the three-element test to decide. So the three-element test is applied only in two circumstances. The three-element test is applied only in two circumstances. You fail the concentration test, that's one, or you refuse to apply the concentration test, that is two. The moment you choose to apply the concentration test, in that particular case, there is no U-turn. Then you said you passed the test and it's not a business. No further actions can be taken. I hope I'm very clear on my thoughts at the moment. So now let's understand what is this concentration test all about. I'll take a very simple example to first explain some basic fundamentals on the concentration test. Then we'll dive a little more deeper into this. So let's understand now the concept of concentration test. So we're looking at the optional concentration test. We're looking at the optional concentration test. So let's understand now what is this optional concentration test. I'll take a simple example. What I'm about to tell you is not conceptually correct, but this is only as a basic understanding to begin with. I'm giving you this example. Let's consider a company acquired, let's say, 3 assets A, B, C. And let's say the fair value of these assets individually 95 crores, 3 crores, and 2 crores. So let's say the company acquired 3 assets ABC, and this is the fair value of ABC. And let's say the purchase consideration paid is to the extent of 100 crores. That's the sum total of these 3. You add these 3, it comes to 100 crores. Now I'm going to say a sentence, and I think you can easily vouch me on that sentence. Can I say, looking at the data, 95% of the consideration, mind the word, I'll put it across. Can I say 95% of the consideration? 95% of the consideration is concentrated in a single asset. Tell me yes or no. I said 95% of the consideration is concentrated in a single asset. You paid 100 crores, but 95% of what you paid is paid for a single asset only. Effectively, did you acquire multiple assets or a single asset effectively? And I think you'll agree with me that if majority, this 95% is in my example, but the standard says that if a substantial percentage, the standard uses the word that if a substantial percentage of the consideration is concentrated in a single asset, you effectively purchased a single asset. If you effectively purchased a single asset in this particular case, if this be the case, then it is not a business. Because you are, though acquiring more than one asset, but effectively you are acquiring only a single asset. So they decided that let's apply a very basic litmus test in life. And just let's evaluate and understand that if a major portion, a substantial portion of your consideration is paid for a single asset. And let me also tell you, it can be a single asset or it can also be a group of similar assets. It can also be a group of similar assets as well. Not necessarily that it'll always be a single asset. I'll have to see that, if I've acquired a group of similar assets and substantial percentage of my consideration is concentrated in buying those single assets or buying a group of similar assets, then in that particular case, it is not a business because you're effectively paying for that single asset or for a group of similar assets itself. I think that's a very basic example to appreciate the concept of a concentration test. Okay, are you now ready if I now take you deeper into more maths and try to understand the concentration test in detail? There is a wonderful illustration which is given in the study material which illustrates the concept of a concentration test with a complete illustration. I think let's begin the journey and let's now go to that illustration as well. That's right, single asset collectively acquired. So in step number 2, whether both the two tests should be filled? No. As I've already given you in the chart, you can just go back and correct this. This is the extension of my step number 2. The 3-step which I gave you, so this is what you need to apply in the main step number 2. So in this step number 2, what you have done, you decide to apply the option concentration test, yes or no. This is the entire procedure in step 2. If you say, yes, I apply the test and you pass the test, I'm decided it's not a business. 1. If you apply the test and you fail the test, then you apply the IPO test. You don't need to apply both of them. The both tests will be applied only you decided to apply this test and you fail the test, then you apply the other test. You decided to apply this test and you pass the test, then you don't apply the IPO test. Or you directly decide to apply the 3-element test because you said, I don't want to apply the concentration test. So both the tests are not to be conducted. There are 3 possibilities. IPO test not applied, so apply 3-element. IPO test applies and passes, done. IPO test applies and fail, then the 3-element test would also apply, right? Okay, is it a doubt in the chart given? It's doubt than the chart. Okay, I think now it gets clarified, right? Okay. Now let's go on to the further details and go to the concentration test. Now, I am going to take you to the study material and there are some interesting inputs which are given. But before that, there is another question also, which is given on that group of assets and all. I'll come back to illustration 1 very shortly. Then I'll keep connecting the dots to you. So let me first go on to the concentration test. Okay, let me, I think, just crop this up and then we'll discuss this in detail. I'll make some notes also later, no worries. But I think first we need to look at this example. This is in chapter number 12. And in terms of the chapter number 12, I'm looking at this example 1 on the concentration test. I hope, friends, it's clearly visible to you. So you can clearly see the board, I guess, visible. Okay. So if the concentration test passes, then Ind AS 1640-38 may apply. Yes. Because if the concentration test passes, that means it's not a business. So that means you paid a consolidated consideration towards buying multiple assets, then split the consideration in the ratio of fair values and you apply 16, 38, 40. Absolutely. Okay, now I'm just going to read this illustration to you. It might take me 15, 20 minutes or maybe more in order to get the complete binding on this particular example. So now you're about to see a little more technicalities. So don't get worried as I proceed, but it's important to understand this example very well. Let's read. I'm just going to read this example. Then before solving, I'll just come out of this. It says A has got 20% interest in B and subsequently A further acquires 50% share in B. Okay, let me just come back on this. Now, please watch this carefully. I'm going to explain some basic maths to you. I'm going to give you some logics and basic maths. So please hear me carefully. I'll pen down the notes later, but let's first understand the larger picture very clear. Let's say there is a company A Limited and let's say there is a company B Limited. So let's assume that company A Limited earlier acquired a 20% stake in B. And now it acquired, let's say, another 50% stake in B. You will see later that this is technically called, we'll use this term, it is called step acquisition. You'll see this later that this is called step acquisition. So A had a 20% stake. So you can say that A had a significant influence over B, and then he made a further acquisition, or you can say step acquisition, and now he obtains a control. So if I take the sum total of this percentage, it works out at 70%. Now, the remaining 30% is with somebody else, and that somebody else is called NCI, non-controlling interest, which in the intermediate level used to call it as minority interest. Now we don't use the word minority interest, we don't use the word MI, we use the word non-controlling, because if A gets a control, then the remaining 30% is the people who have no control, so non-control. So we can say, in this particular case, we can say the remaining 30% is what is called NCI. That's called non-controlling interest. That's called non-controlling interest. So I think if you add all this, it works out to 100%. It works out to 100%. I'm just giving you some basic maths to understand that A got 20% stake, then acquired another 50% stake. He's got a 70%, so which means he's got a control in this case, and the remaining 30% is with somebody who's got no control, so that's non-control. So we can say 70% control and 30% non-control makes it 100. Now, let's go and read further. I'm coming back on the example. I'll come back to this, no worry. So I just want to read it back again. So it says A holds a 20% interest in B. Subsequently, he acquires another 50%. So 20 plus 50 makes it 70. So there is a 30% NCI. Okay, then it says the fair value of the assets acquired, etc., is given. So we are given the fair value of the assets acquired and the liabilities assumed is given. So I'm given some data regarding the fair value of the assets and all. Then he also gives me the fair value of entity B is 400 crores and the fair value of the NCI is 120 crores, which is 30% of 400 crores. But this is the valuation of the business. This is the valuation of the business, and NCI is 30%, that makes it 120 crore. And he says the fair value of the previously held interest, that 20%, is supposed to be 80 crores. Now, friends, I am going to ask you a question on a mathematical level, and you need to decide this very carefully. Let's go back to the example. Now, let's consider that the purchase consideration, what he paid now, the purchase consideration in this case, I'll just take the same figures intentionally. So in this particular case, let's say the purchase consideration which I paid is to the extent of 300 crores. So this is 300 crores. And I'm also given the fair value of this 30%, that is 120 crores. And I'm also given the fair value of this particular portion. The fair value of the previously held interest is 80 crores. Okay, now please hear this very carefully. I'm just going to give some basic maths now to you. I know the fair value of 20%. I know the fair value of that 50%. I know the fair value of that 30%. If I add all the three, is it going to give me the fair value of what I paid for the business of B? Yes or no? If I say in this case, I add 80 crores plus 300 crores plus 120 crores, is this going to be the fair value if I would have acquired 100% stake in that company? Because I paid something to acquire 20% in the past. I've updated that this is the value which I would have paid today. Then I've also paid something for that 50. Then I'm also considering that 30%. So if I add these three, will I be able to get what is the fair value I would have paid if I get 100% control over the business of the company? Is my thought correct? Yes. So I think if I just add these figures, add the figure what is paid for 20%, add the figure what is paid for 50%, and add the figure which is paid for 30%. Let me just add this: 80 crores plus 300 crores plus that 120 crores. And I think this works out at how much? I guess this works out at a total of 500 crores. So this is, you can say, the money which would have been paid as of today. Please mind the words. This is the money which would have been paid as of today if you want to get 100% control over the business. Now, my question is this money paid for acquiring the assets or net assets. Think carefully and answer. So when you say that this is a total of 500 crores, which you would have paid to acquire the business of B Limited, is this the money which you would have paid to acquire the assets or the net assets? And that's rightly said. So this is the money which would have been paid to acquire the net assets. Don't worry, I'll connect the dots once again, but let me first go with the flow. So can I say this 500 crores is what is paid for the net assets? So that's important. That this 500 crores is what you paid for the net assets. Now imagine if you want to apply a concentration test. What do you need in this case is what is paid for all the assets, not net assets. Because you need to identify what is the percentage paid for that single asset. So I need to translate that what is paid for the assets of the company. So let me ask you another mathematical question. If I want to convert this in terms of that what is paid for the assets, if I want to convert this that I paid for the net assets 500, but I want to calculate what is paid for the assets, what should I do on a mathematical level? Should I add the liabilities and then decide what is paid for the assets? Say yes or no. So I know that 500 crores is paid for the net assets. So I want to understand what did you pay for the assets. And if you want to decide what is paid for the assets, should I add the liabilities in this case? Yes, let me go back. So in this particular case, if I look at what is paid for the liability, we know that as far as the liabilities are concerned, so we know the liabilities in this case we paid is 800 crores. 800 crores is what is paid for the liabilities in this case. Now, when you are considering the liabilities in this case, let me tell you one thing point blank at this stage. I am not considering notional liability. Deferred tax asset liabilities are notional in nature. So when I add the liabilities, I'm not going to add any notional liabilities. We will add only actual liabilities. So in this particular case, when you add the liabilities, we will take only the actual liabilities into account. We will not consider any notional liabilities. So notional liabilities will not be added back in this case. So we can say to this, I add this 800 crores. So what is paid for the assets is 1300 crores. No worry. As I said, I will connect the dots very soon. Just see the flow. I will connect every data very shortly again, but just see the flow. So we've reached a conclusion that 1300 crores is paid for the assets of the company. But now there is another little small input to be evaluated in this case. Now let's have a look further out here. If you notice in terms of assets, there is a cash and cash equivalents to the extent of 200 crores. Can I say, if you see, I paid money to get the assets. So on one hand, you paid cash. On the other hand, you get a cash. So can I say it should be eliminated? So why should I calculate what is paid for the assets? I should calculate what is paid for the assets other than cash, because you make a payment of cash and then you acquire cash. So that should get eliminated. So what we'll do in this case, the 200 crores in this case. So we'll go to the next stage. So what do? We will say, okay, let me calculate what is paid for assets other than cash. What is paid for the assets other than cash? So I've converted this in terms of three elements. I understood what is paid for the net assets. I said, no, I want to understand what is paid for the assets. Then I said, no, I want to understand what is paid for the assets other than cash. So in this particular case, what I will do, I will reduce the element of cash to understand what is paid for the assets. So 200 crores is cash. So this comes to a total of 1100 crores. How much did you pay for the assets other than cash? I paid 1100 crores for the assets other than cash. And now let me go back and connect the dots. Now further, you need to identify out of the list of all the assets and liability, which asset has got the highest value. Now you need to filter out that which asset has got the highest fair value, and we can say building is the one which has got the highest fair value. So if I come back and calculate, in this case, so we can say in this case, building is the asset which has got the highest fair value, that is 1000 crores. The company paid 1100 crores and one of the assets acquired is 1000 crores. So what percentage of the consideration is paid towards the building? What percentage of the consideration is paid towards the building? So 1000 divided by 1100, we can say approximately 91% is paid for building. So if 91% is paid for the building, this will be considered substantial in nature. And if this is considered substantial in nature, we can say it is not a business. It is simply an asset acquisitions. It is not a business. Sir, can you please repeat all this once again? This is got over the heads. Am I right? I've done some mathematical calculations. You would say, sir, what is this? This has got too technical indeed. Please consolidate the entire inputs of what you've done. Great. I'll do that. So what about that 70%? What is that 70%? I didn't get that. Okay, I think first connect the dots once again. Now, let's go back and let's understand a few inputs. We'll read the example once again. And then we'll create a complete step-by-step model in terms of deciding how the concentration test is applied in this case. So let me, I think, first give you some basic inputs out here. 70% stake. Okay, no worry. That'll get taken care. No worry. Just hear this. I'm just going to clear this once again, and we're going to work upon the inputs in this case. So let me, I think, first ask you some quick questions as we read this illustration as well. So let me quickly ask you a few questions as well. If I first buy something from another company, let's first appreciate one very important question. It says the fair value of the assets acquired and the liabilities assumed are given. Can you tell me, looking at this data, which asset has got the highest value? Tell me which asset has got the highest value in this case. I want to identify which asset has got the highest fair value. So we want to understand which asset you acquired has got the highest fair value. And I think that's right, building. So we can say building is the asset which has got the highest fair value, that is to the extent of 1000 crores. Now let me ask you a very basic mathematical question at this stage. Building is worth 1000 crores. So this is asset. This is asset. So if you want to compare what did you pay, are you going to compare what you paid for the net assets, or are you going to compare what is paid for the assets? Please think on a mathematical level at this stage. The company said that I acquired something. I said building is the asset with the highest fair value. So if you want to compare them, what did you pay? So should I compare what did you pay for the group of assets or the net assets? So please answer that question. When you want to mathematically compare, so you will say this is what is the value of the asset. So you need to compare it with what did you pay for the assets in total or the net assets in total. I think that would decide the fate. And that's right. The building is the highest fair value. So I'm yet to get the answer to my next question. You said building is to the extent of 1000 crores. So if you want to compare what did you pay, should you get what is paid for the assets in total or for the net assets? And I think it makes sense. I should now make this comparable and we should get what is paid for the assets in this case, not net assets. You're saying this is the value of that single asset. So let me find out what did you pay for all the assets together. Comparability on a mathematical level will arise only when you say this is the building, which is the asset. So what did you pay for all the assets together? So there is a need to convert the consideration which is paid for the assets in total. Now, another thing. This is the building of the company as a whole, but you acquired a 70% stake. But when you get a control, in that particular case, you would say that you get a control over the entire business. But can you compare what you paid for 70% versus the building? No, building is the entire building of the company. So you need to see that what is paid if you would have paid for all the assets put together. So there is a need to convert it into two layers. At the first stage, you acquired a 70% stake in the company. Now, your building is representing a full asset. The building is representing a full asset and you acquired a 70% of the asset, not comparable. So there are two things which needs to be done. You need to first of all get what did you pay for 100%. If you would have acquired 100%, how much you would have paid for the assets. So there are two things to be done. So what I did in this case, what's this? At the first instance, I know that what I paid for the net assets in entirety. If I would have acquired a full control over all the assets and liability, so when I took the sum total, of this 500 crores, what is this 500 crores? What you paid for 20% plus what you paid for 50% plus that NCI. So when you add all these three, you've done one thing. Had I acquired 100% of the business, the building is 100. Remember, the building is complete building. Had I acquired 100% of the business, I would have paid 500 crores. So we converted what is paid for the 100% net assets. So when you add the previously held interest 20, when you add the purchase consideration 50, and you add the NCI, you reach a point how much you would have paid for 100% of the net assets. So we translated, if A would have acquired 100% of the business, that is 100% of the net assets, he would have paid 500 crores, agenda 1. And then we said, I don't need what is paid for the net assets. I need what is paid for the assets. Because building is the asset. So I can't compare it with what is paid for the net assets. I need to convert this in terms of what is paid for the assets. So I said, okay, if you paid an X amount for the net assets, add the liabilities, you would have paid more amount for the assets. So what I did in this case, I added the liabilities to get what is paid for the assets in entirety. So from the stage of 70, we made it 100, 1. And then from the state of 100, what is paid for the net assets, we said, let's consider what is paid for the assets. So 1300 crores is paid for the assets, but there is another catch as well. And that is, if you're acquiring cash, you're paying cash. What's the fun of taking that? One hand you pay cash, one hand you acquire cash, eliminate that. So let's see what is paid for the assets other than cash. So we said, let's convert this in terms of what is paid for the assets other than cash, so that I know that what is paid for all the assets, leaving the cash. So once I added the cash, I came to know that 1100 is what is paid for all the assets. So mathematically what you've done, converted the input. If you would have acquired 100% business, 1, what you would have paid for the assets other than cash, that is 2. You said, I would have paid 1100 for acquiring all the assets of the company other than cash. And in the list of the assets now, you've got building, which is worth 1,000 crores. So effectively, you paid 91% of the consideration paid. 91% of the consideration paid towards the assets of the company. 91% of the consideration which is paid towards the assets other than cash is paid towards the building. Mathematically, it becomes comparable. So now you can say this is building and this is what is paid for the assets only other than cash if you would have paid 100%. So if you would have got a 100% stake, what you would have paid for all the assets other than the cash of the company, you realize 95% of the money paid is paid towards the building. So basically, you paid effectively for the building. It's not a business, it is an asset acquisition. Did you get the dots connected? I'll convert this all into a chronological steps as well. But did you get my points, friends, on this? Okay, so yes, I get the answer. That's great. Okay, I got a question, sir. The notes on financial instrument lecture 1 and 2 not visible on the app, trying to find it multiple places. I'll maybe upload it once again, though I have already uploaded. No issues, I'll do that once again. So, but sir, this case, when in actual business, my actual assets are building, let's say rental business or something. No. In a concentration test, we are not looking at the nature of the business. The concentration test is basically, you can say, a quantitative test. You know, the IPO test, which is the 3-element test, is more like a qualitative test. The concentration test is only playing on numbers, not on the nature of the business. We are just looking at on a mathematical front that what you are paying for the assets of the company. So nature of the business will be completely irrelevant when you're doing a concentration test, right? Okay, so I think let me just now connect some few more dots in this case. So understood what would be the substantial percentage in journal? Now that's a good question. The standard nowhere tells us that what percentage is considered substantial, but generally we assume that if it is more than 90%, we can say yes, effectively it is substantial, but there is no guidance in terms of the standard. There is no cut-off percentage which would decide, what is substantial in nature. Correct? Now let me just come back on the example and I think take it further. So, but isn't this the case when in actual business, my actual assets are building? Okay, that one was done. So it means an acquisition will become business in an IPO test. If you pass the IPO test, not otherwise. You see, if you fail the concentration test and you apply the IPO test, that doesn't mean it's a business. Unless you pass the IPO test, you cannot say it's a business. You might fail the IPO test as well. Then in that case, it will be considered as that it's a multiple asset acquisition and not a business acquisition in that case as well. Correct? Okay, now let's come back on the example once again. Now let's see the inputs out here. Then after this, I'm going to pen down the steps to you in detail. Okay, let's, I think, come back. So it says A's got a 20% interest in B already. This is called PHI. This is called PHI, previously held interest. A further acquires a 50% stake by paying 300 crores. So 20 plus 50 makes it 70. The fair value of the assets liabilities are given. So we can see the list of building, cash, financial liabilities and DTL. So this is all actual assets and liability. But this is something which is a notional liability in nature. Then he says the fair value of the entity B is 400 crores. The fair value of the NCI, that is 30% of 400 crores, is 120 crores. And the fair value of the PHI, previously held interest, is 20% of 400 crores, that is 80 crores. Entity A needs to determine whether it is an asset acquisition as per the concentration test. Now see what you're going to do. I'll just give you a step-by-step approach, then we'll document that steps as well. See what you're going to do. So I will give you now a simple 3-step model in terms of applying this procedure. So again, a three-step model. Yes, on the concentration test, you need to apply on a chronological manner three-step model. Logic's given, but let's now see the three-step model. So when I'm going to apply the three-step model, see what am I going to do? Number one. Here this, I'll document that later, but here this. Identify the single asset or a group of similar assets with the highest value. Mind the words. Identify the single asset or the group of similar assets with the highest fair value. So what is the asset with the highest fair value? Building. So we will identify the single asset or a group of similar assets which has got the highest fair value. And let's see that out of all the kitty acquired, which asset has got the highest value. So we can say building is the one which has got the highest value in this case. Then we go to the step number two. Now, in terms of the step number two, you got to convert things in a very chronological order. Step number 2A, step number 2B, step number 2C. Don't run. So we're going to consider step number 2A, step number 2B, and step number 2C, one by one. So first of all, we will add the sum total of PHI, previously held interest, the purchase consideration, and the NCI. First, I'll add the three inputs. Add the PHI, the fair value of the PHI, previously held interest, and then add what is the PC paid for that 50% and add the fair value of the NCI. When you add these three up, you get what is paid for 100% net assets, stage one. Once you add these three, you get what is paid for 100% of the net assets. So the order is 100% net assets. Then the step number 2B, what I'll do to the value in step A, I'll add the liabilities, but only the actual liabilities, not the notional liability. In step number 2B, I'll add the liabilities, which are actual liabilities, no notional liabilities. So DTL is the only notional liability in the balance sheet. There is no other. There is no other notional liability. So we would add the DTL. So we'll add actual liabilities, leaving the notional liability. So once you add this up, what do you get? You get what is paid for 100% of the assets. From the 100% of the net assets, you get what is paid 100% of the assets. And then in the stage number 3, we'll take the value of B and reduce the cash. And reduce the cash and the cash equivalents in this case. So in step number 2B, you will add back the liabilities, actual. In step number 2C, you will reduce the cash and cash equivalents because that is ek haath de, ek haath le. So what am I concerned with that? So in this particular case, we get what is paid 100% of the assets other than cash. Now, once you get the inputs in terms of step number 2 ABC, then we go to step 3. The step number 2C is giving you a comparable figure to step number 1. In step number 1, you have the value of that single asset, 100% of the single asset. And in step number 2C, you have 100% of what is paid for all the assets put together. So now what we'll do in step number 3, we will take the value in step 1 by the value in step 3 to see, calculate the percentage. If this is substantial, it is not a business. If it is not substantial, you go to the IPO test. Don't worry, I'll document all that up. So if you calculate a percentage 1 divided by 2C, the value in step 1, that is 1000 crores, the value in step 2C, that is supposed to be 1100 crores. If that figure is substantial, it's not a business. No need to go to the IPO test. If it is not substantial, then you need to go to the IPO test. Clear, friends, with this? I hope I'm pretty much clear on this. And I think we've already worked out that 91% already. That is the agenda. So we've created a three-step model on the concept of a concentration test. Now you need to be crystal clear what is to be done in each and every step. Let's document this part. So far, so good. I hope, friends, you stand clear on the concentration test now. So let me do one thing. Let me just pen this down. So we're going to go to the optional concentration test. Though we are technically still working on our step number 2, which is the business test. So we're looking at the optional concentration test. And we're just trying to create a mathematical parity in terms of this. Okay, so far so good. Great. So can we call instead of it not a business acquisition, instead it is not a business? Yes, you call it that it's not a business, or you call it it's not a business acquisition, one and the same thing. Not a business means it is an asset acquisition. When I say not a business, it means asset acquisition. Okay, so we go to the three-step model again. So we go to the three-step model in this case. No worries, as I maintain the flow, my constructive obligation comes every time that when I go to the next session, I'm going to give you quick mind maps on the learnings on the previous session. So once you revise it well, and then I make my mind maps in the next session, you will connect the dots easily on that case. So you need to do your cumulative revisions. I continue my constructive obligations of giving you cumulative mind maps at each stage. Okay, so let's, I think, begin with the step number 1. So in the step number 1, what I need to do at the first instance, we need to add, you can say 3 things. You need to add the purchase consideration. You need to add the PHI. Let's first take the PHI. That is called previously held interest. That is called previously held interest. And you need to add the NCI, that's called non-controlling interest. That's called non-controlling interest. Now, in this example, you can correlate this absolutely well. Then once you add the PC plus the PHI plus the NCI, would you like to tell me what do I get? Can you tell me what do I get? What is paid for what? So in my example, this is 50%, and this is supposed to be 20%, and this is supposed to be 30%. So would you like to define that this is what? Correct. This is what is paid for the 100% net assets. Very good. So we can say this is supposed to be what is paid. This is supposed to be what is paid for 100% net assets. The focus is on 2 things. The focus is on 2 things. You get what is paid for the net assets 100%. But we know that the idea is to convert what is paid for the assets other than cash. So now we go to the step number 2. So now we go to the step number 2, in which we've got 3 sub-steps. So in terms of this, we are going to go to the 3 sub-steps in this case. So we've got the step number 2A, step number 2B, and the step number 2C, one by one. So that you never ever commit a mistake. Now, in terms of the step number 2A, what I'm going to do, I have already calculated that this is 100%. So rather, let's take step number 1. Let's take the step number 1. What is paid for 100% of the net assets. Now, what you need to do in this particular case is you need to add the liabilities. And which liabilities will you add? Actual, not notional. So we need to add the actual liabilities and not notional liabilities. And the only notional liability which we have got, the only notional liability in the balance sheet is a DTL. There is no other notional liability. Okay, now tell me, once you do this, tell me what will you get? Once you do this, what do you get? What is paid for 100% of the assets? Correct? So we add the liability, so we will get what is paid for 100% of the assets. So what is paid for the 100% of the assets? So from that 100% net assets, we get 100% assets. And then what do you do in the next stage? In the next stage, now what we need to do, we need to reduce the cash and the cash equivalents. We need to reduce the cash and the cash equivalents at this stage. Now tell me, what do you get? Once you reduce the cash and the cash equivalents, you get what is paid 100% of the assets other than cash. So you get what is paid for 100% of assets other than cash. What is paid for 100% of the assets other than cash and cash equivalents? So these are the two focus points. The logics are given, and now you should correlate better. So from 100% of the net assets, you go to 100% of the assets, then you go to the 100% of the assets other than cash and cash equivalents. So it's a very simple exercise. Add the actual liability, reduce the cash and cash equivalents, so that you're able to get what is paid for 100% of the assets other than cash and cash equivalents. Okay, so this was the step number one. That is, you add these three figures. Rather, I think this is, I think what I should do technically, not call this as step number one. I should rather call this as step number 2A actually. I should call this as step number 2A actually. Let me just add the step number one further, because this is actually the step number 2A which I've done. When you add these three up, so this is the step number 2A, where you've added up all these things. So this is the sum total C above. I've written above because that's going to be in the above chart. Let me, I think, first make this step number one. Identify the single asset. Identify the single asset or group of similar assets or group of similar assets. So we will identify the single asset, or you can say the group of similar assets with the highest fair value. With the highest fair value. So that is the focus, that you need to identify the single asset, or you can say the group of similar assets which has got a highest fair value. In my example, it was building. In my example, it was the building which has got the highest fair value. Okay, so this takes care of the step number one and the step number two, ABC. And finally, we go to the step number three. So what do? You calculate a percentage. You calculate a percentage which is the value in step one divided by the value in step number 2C. So you will take the percentage, step number one, the value as per step one divided with the value in step number 2C and get a percentage. Now, once you get the percentage, so it is either substantial, or it is not substantial. There is no definition which is given for substantial. As I already said, substantial is subjective, but generally we assume it to be 90% or more, but this 90% is nowhere defined. So in this particular case, when you say it is substantial, then we can say it is not a business, then it is an asset acquisition. So if it is not a business, it will be considered as an asset acquisition. And if you say it is not substantial, you go to IPO test. In that particular case, you need to go to the IPO test in this case. Wonderful. I think that gives us the dots connected in terms of the concentration test. Now, I think before we proceed further, it's time to first get your comfortable zone scores. So we have done basically the three-step model, which opens the gateways to various standards to be applied. And I've also given you the concentration test three-step. So basically three steps given twice. One is in terms of deciding which standards will trigger. And then in terms of the step number two, within the step number two, there is concentration test. I've given you a three-step model, how the concentration test is applied. I get the first score 9 by 9.9. That's wonderful indeed. Let's get some more comfort zone scores. How do you feel comfortable so far on your learnings on 103? Okay, that was a great score. Let me see more scores coming in. 10 by 10, that's wonderful indeed. 9.8 by 10, what a psychological score indeed. Wonderful. Okay, now I'll just come back to the input in step two. The first one was the concentration test, which is optional. But then the next test is what is called the three-element test, or what is called IPO. So now we're going to go to the next test, which is called IPO. And there is a very interesting chart which is given in the study material. And I think I'll just like to show this because now we're going to work upon this particular chart itself. Let me just, I think, crop this and show this to you. Let me know, friends, if this is visible to you or not. Maybe it might be a bit small, then I'll just maybe cut down the parts below. Is that visible? Otherwise, I'll maybe delete some more portions if the visibility is not that great. Okay, maybe you can just have a look at the A and B, because in terms of A and B, it's only written A is asset and B is business. So if this is not too much visible, can manage. Okay, no issues. Let's do one thing. Let's cut this down. So I guess I'll cut it across here. Let's make it better. Now this will go back. I think this should be visible now. I think so. It might be visible now, I think. Yes, should be. So let me just make a run through. No worries, we just need some bits and parts on this particular chart. So let me, I think, first give you some basic input. Before we'll take a break, I think we'll just give you some basic inputs to work upon. Then we'll take a break. First, let me just give you the basic inputs. This is the three-element test. This is the three-element test, or what I call the IPO, because the three elements are input, process, output. Now, first, let's have some very basic understanding on this IPO. There is input, process, output. Let's say, for example, I'm a car manufacturer. So I would have certain inputs, let's say the steel sheets to make the car. I don't know, it's made out of iron car, whatever. Don't judge me on that. I'm just taking an example. So let's say I'm a car manufacturer. So I've got, let's say, some iron sheets or steel sheets, whatever, that becomes an input, and the car becomes an output. Now, there will be some kind of a process which will convert the input into an output. Or let's consider another example. Let's say a company like Coke and Pepsi, they are producing Coke and Pepsi. So what is the input? It would be water, for example. And what is the output? It is the Coke and Pepsi they're producing. So that input is getting converted into output through some formula. And that is what is called a process. The standard setters were very convinced on one particular front that if you want to call something as a business, acquisition of the process is the most important element. Because you may acquire an input for sure, but there may or may not be output. Output is also representative in terms of the revenue the company is generating. Output is not only the physical output, but output also represents the revenue which the company is generating. So when I'm looking in terms of the acquisition to be called as a business, the most important element is the process. You can say the process, the formula with which the input is converted into an output. But let me also tell you that when you look at a process, it is not necessarily that formulas will only be considered as a process. An organized workforce of the company, all those people who've got the necessary knowledge, the skill and experience with which inputs are translated into output, that is also something which is very important to decide whether it's a business or not. They are also considered as a process. So you can say the organized workforce. When I say organized workforce, I'm not referring to people working in the admin department or people working in the sales and department. For example, if I'm going to take over the business of, let's say, a pharmaceutical company where all the researchers, the scientists are working, then I would say those scientists are the people who have got all the necessary knowledge, skill, and experience with which they know the input is translated into output. So these skilled people are not only the input of a business, but they're also the process of the business. So therefore, the standard setters decided that one way to look at whether it's a business or not is a quantitative test. You can see the concentration test is purely working on the quantitative part. It is working on that what did you pay in terms of the consideration, 90% or not. We're not looking at any other thing. But the moment the concentration test fails, it is important to look at the qualitative test, because quite some time back, before the standard was revised, the entire assessment of business or not was largely based on qualitative test. And trust me, qualitative test can be sometimes very, very subjective indeed. And therefore, the standard setters wanted to ease the assessment, and they said, let's first go for an optional concentration test, which is a mathematical test, and that will decide the fate. But sometimes companies may not be comfortable in terms of deciding all that. So in those particular cases, a qualitative test is necessary. Now, there are two special issues which are still pending. Let me just tell you what are the special issues, because I need to come back to them as well. The special issue number one in my discussion is that when a company acquires a group of asset which is not a business, how does the accounting take place? There is an illustration which is devoted in the study material on that. Right now, since I'm concentrating on the business test, I'm not getting into that special issue. And there is another special issue also which could have been asked initially, that why are we making a distinguish between that it is an asset acquisition or a business acquisition? What is the difference in the accounting treatment when it is an asset or a business acquisition? So that difference has also been outlined. So remember, after I'm done with my IPO test, I need to discuss two special issues with you. One special issue, that if you acquire a group of asset which is not a business, how do you decide? The second special issue which I need to discuss with you is what is the difference in the accounting treatment? So what are the parameters when it is an asset acquisition or a business acquisition? How does the accounting differ? So I think conceptually we need to work on those two special issues as well. Anyway, that's just giving you some basic backgrounds at the moment. I think it's time now to first give you a small break so that you can relax your minds, and then we can start with the relaxed minds on the business assessment, that is the IPO test. So let's take a quick recap, a quick rest as of now, 10-12 minutes. I start back after that. Relax your minds. हाँ जी, ब्रेक लगा दीजिए. ओके. that relaxation of mind. So I guess before the break, we were talking in terms of the three element test or what is called the IPO. And just to give you quick reconnects once again, as I said, the concentration test is more on a mathematical front. It's more like a quantitative test. And the IPO or the three element test is more on the qualitative run, wherein we are not going to look at any mathematical figures, but we're going to make some qualitative assessment and then decide that is this going to be a business or not. So let's, I think, come back on the chart and see. It's a wonderful summary chart which is created for the three element test. No worry, we'll do some case studies also after this. So I am given in this case, we ask ourselves, did we acquire the input and process? I'll put it like step number one. I'll convert this also into a three-step model. So we have done the three-step model in terms of deciding which standard triggers. We've done a three-step model on the concentration test. Now we're going to do a three-step model on the IPO or the three-element test as well. So I would say this is your step number one, that you're going to put across a question, did we acquire input and process? You can see the word output is nowhere there. So at the first instance, I will only put across a question that did we acquire the two elements input and process? The answer would be either a yes or a no. If the answer is a no, it is go to A, asset acquisition. A stands for asset acquisition. So your very first step when you say that you acquired input and process, so maybe you acquired inputs and no process. Outrightly, it is an asset acquisition, not a business combination. But if you say a yes, then you go to the step number two. And in terms of the step number two, now the crucial input is to decide the presence of output, whether the output exists on the acquisition date. Now you can see the role of the output is there in terms of step number two, not in terms of step number one. Your step number one is looking at input and process, and the step number two focuses on the output. Now, when I say that the output is there or not, output would be in the form of revenue. So if the company is already generating a revenue, I would say there is an output. And if the company is not generating revenue, I would say there is no output. And you can well imagine there will be a separate kind of parameters to evaluate if there is no output, and if there is an output, the parameters involved will undergo a change. So in this particular case, when you say the output, that is revenue, is there or not, we will technically go to step number three, whether it's the answer is a yes or whether the answer is a no. Now let's, I think, put a simple question to you. Do you think if there is no output, then the parameters will be more strong to evaluate whether it's a business? Or do you think when the revenue is there, then the parameters will be more strong? Which case do you think the parameters will be more strong in nature? If there is a revenue or if there is no revenue, where do you think the parameters are going to be more stringent in order to decide whether it is a business or not? And I think you'll rightly decide that when there is no revenue, I think that will make complete sense. That's absolutely correct. Without revenue, the parameters are going to be strong. So first, let's see if there is a revenue, then what? It says whether it is critical. It means the process. We're looking at the process. Is it critical to the ability to continue producing the outputs? And the inputs acquired include an organized, experienced workforce. So there are two conditions. When there is a revenue, there are two conditions. The question number one is the process critical? Now you would say, what do you mean by that the process is critical? Well, there is no explanation in the standard which explains what is critical, but critical is something, which is very important. When you say that the person is in a critical stage, you understand the basic sense that the process is critical. Without this, we cannot do anything. Critical. And then there is a second parameter that in the inputs, apart from, let's say, the raw material, the building, the machinery, you must have also acquired the organized, experienced workforce. The word used is organized, experienced workforce, because these are the real processes actually. The people who've got the necessary skill and knowledge are supposed to be the real processes for you, because if you acquire those people also along with the business, then they can convert the input into output. Now, in this case, if you say a yes, it is a business combination. But if you say a no, then there is another set of parameters. Then there is another set of parameters. So when there is a revenue, there are two set of parameters. There are two set of parameters. One is this parameters. There are two conditions in the block one. And then you can say, even if the block one is not met, you go to the next block, whether the acquired processes is unique or scarce, or it cannot be replaced without significant cost, effort, or a delay. So you need to put across a question that is the process something which is unique, something which is scarce in nature, and it cannot be replaced. And it cannot be replaced, or it cannot be replaced without incurring a significant cost, effort, or you can say a delay. So you can say that the process is something which is unique in nature, something which is scarce in nature, or something which you can't replicate. Something which you can't replicate without incurring a significant cost, or without significant efforts, or without significant delay. It'll take a lot of time before you could replicate those processes. It'll take a lot of efforts. It'll take a lot of cost involved as well. So if you say, in this case, yes, it is a business, and if you say no, it is an asset acquisition. So let me connect the dots. The standard said that if there is a revenue, that means there is an output, then you've got two blocks. You've got two blocks. The block number one has got two conditions, and the block number two has got one conditions. Either you meet the two conditions of block one, or you meet one conditions of block two. Now, what are the two conditions of block one? You need to prove that the process is critical, one. You need to prove that along with the inputs, you have taken the organized, experienced workforce as well. If you can prove both the conditions, it is a business. Otherwise, you go to the block two. In terms of block two, you need to put across only one condition. Either tell me the process is unique or scarce, or you tell me that the process cannot be replaced without incurring significant cost, effort, as well as a delay. So in this case, if accordingly you decide it's a business or not. Next, if you say the output is not present, then we will say whether it is critical to the ability to develop or convert acquired inputs or inputs into output. So the only one question to begin with is the process critical, and is the process critical, and whether the inputs acquired include both organized workforce and includes other inputs, the workforce could develop or convert into output. So you can say there are three conditions. If there is no revenue, if there is no output, then there are three conditions. Two conditions are common. The process is critical, one. Then you can say you acquired an organized workforce, two. And number three, apart from the organized workforce, there are other inputs also which is acquired. So if there is no revenue, you've got three conditions. The process is critical. Then you need to see that you acquired organized workforce. And number three, you organized the other inputs as well. If the answer is a no, that means any one condition fails. It is supposed to be a case of asset acquisition. And if you say a yes, then it is a business acquisition. No worry, I'll convert this all into a three-step model, document the inputs to you. So once you choose, mind the words, once you choose not to apply the concentration test, one, or you choose to apply the concentration test and you fail that test, it is only then that this three-element or IPO test is done, in which we've got three focus points. One is you need to see that did you acquire input and process. If you outrightly say no, it's an asset acquisition. If you say yes, we go to the step number two, and then the focus is the output present? The presence of output is the entity generating revenue? then you can say, yes, there is output. If the entity is not generating revenue, then there is no output. Irrespective, you go to the step number 3. If you say that there is a revenue, you meet either 2 conditions of block 1 or you meet 1 conditions of block 2. And if you say that there is no revenue, you've got 3 conditions to be met. If those conditions are met, it's a business. If those conditions are not met, then it is an asset acquisition. Now, we'll see how do we apply this to practical case studies, but let's first document these 3 steps to you. Okay, so I think let me make another 3-step model on the 3-element test. So this is on the 3-element test. This is on the 3-element test, or what I call IPO. IPO, as I said, is nothing but input, process, output. So here again, we're going to create a 3-step model in terms of deciding things. So let me again remind you that we are working on the main step number 2, where we said the group of asset is a business or not. So we worked upon the option concentration test, which is a quantitative test. And then we're working on the 3-element test, which is a qualitative test. Okay, so let's begin with the step number 1. So in terms of the step number 1, we're going to first of all ask ourselves a question. Did we acquire both? Did we acquire both input and process? Output is nowhere in the question in this case. So we'll put across a question. Did we acquire input and a process? So when I say input and a process, the answer is either a yes or the answer is a no. So if you say no, I did not acquire both of them, then it is undoubtedly, you can say, not a business. It is not a business in this case. Rather, we can say it is an asset acquisition. It is basically an asset acquisition outrightly, because acquiring inputs without any processes outrightly, asset acquisition. If you say yes, then we go to the step number 2. Then we go to the step number 2. So that is step 1. Then let's go to the step number 2. Now, in terms of the step number 2, we need to see, is there an output? Is there an output present on date of acquisition? Is there an output present on the date of acquisition? So when I say, is there an output which is present on the date of acquisition, output is represented by revenue. Output is represented by revenue in this case. So when you say, is there an output, either we get the answer yes, or we get the answer no. So in this case, the revenue is there, output is there. Revenue is not there, output is not there. And irrespective, we will go to the step number 3. So irrespective, we'll go to the step number 3. So step number 2 is only looking at the presence of the revenue or the absence of the revenue. Revenue is synonymous with the word output. And then finally, we come to the step number 3. Then we come to the step number 3. And in this particular case, let me first give you the blocks. So we can create a small little chart, just giving you some keywords. So if you say output is there or the output is not there. So if the output is there, then we have got 2 blocks. Then we've got 2 blocks in this case. So there is block 1 and there is block 2. And in this case, we need to meet conditions of any one block. We need to meet the conditions of any one block to call it as a business. To call it as a business. So you need to meet conditions of any block. Either you meet the conditions of block 1 or you meet the conditions of block 2, and then we can say it is a business. So what are the conditions in block 1? 1 plus the condition 2. The process is critical. The process is critical. That is 1. Second is organized. Organized workforce is acquired. Organized workforce is acquired. So both the conditions need to be met. And the block number 2, there is 1, and that is supposed to be the process is unique. The process is unique, or we can say scarce, or cannot be replaced. Cannot be replaced without. Cannot be replaced without significant cost, effort, or delay. So there is either of one of them involved. You cannot replace it without significant cost, effort, or delay. So this is the situation when there is revenue. And in this case, they can say there is only block 1. There is only block 1, and there are 3 conditions. So the first condition is same. The second condition is same. So these 2 conditions 100% same. The process is critical, organized workforce is acquired, and then we can say other inputs are also acquired. Other inputs are also acquired in this case. Right, so I think this is done. So we can say, now we can just put this inputs. So we can say conditions met. So if the conditions are met, it is business. And if the condition fails, in this case, then we can say it is an asset acquisition. You meet the conditions, it is business, otherwise not. Here also the same thing goes, conditions met. If the conditions are met, it is business. And then we'll enter the third step of control. And if you say the conditions fail, then it is supposed to be asset acquisition. Right, so I think that puts across all the 3 steps how you would apply the 3 element, or you can say the case of IPO test. I think it's time now to do some case studies on this so we can see how the application of this can be done. So let's, I think, begin with some simple examples to you. Then I'll take a little more complicated exercise as well. I'll take 2-3 examples with you. 1 or 2 simple examples and maybe 1 or 2 complicated examples. Let's take around 3 to 4 examples to see the application of this. How do you decide? Okay, let me share an example to you on the screen. 2 examples I'm going to share on the screen. Just give me a minute. Just give me a second. I'll just share a question to you on the screen. Okay, so let's share a small little question. So we're going to look at both the tests in this case. We'll see the application of the concentration test also, and we'll look at the application of the IPO test also. So let me just share that on the screen. Just have a look at this case study. Okay, I'm just going to read the inputs to you. So I'm taking a little different case study, something which is not in the study mat, but I'm just sharing that question so we get a little more insights. Now, what's this K3? Shepherd purchases 100% shares in Pi. Let me keep saying a few things to you. Can I say there is a control? if I go with the default percentage that you've got more than 50% voting power in a company, so can I say the step number 3 is undoubtedly met, that you've got a control. You've got 100% shares in Pi. That's right. It says a non-listed company. Now, Pi is got 10 houses which are leased to residential tenants and 2 multi-story office blocks which are leased to commercial tenants. Now, before I read further, I think let me just give you some more thought process at this stage. You can see that company Pi has got 10 houses which are given to residential tenants, and they've got 2 multi-storied office blocks which are given to commercial tenants. Can I call these 10 houses as group of similar assets? And can I also call these 2 multi-story office block as group of similar assets? That means when I'm going to apply my concentration test, can I say I could do a grouping in this case as well? And I think that makes absolute sense. So in this case, when I'm going to apply the concentration test, I will consider that these 10 houses put together is a group of similar assets. They're all residential houses. Then I'm also going to club and consider the 2 multi-storied office blocks as one single asset, group of similar assets. Then he says, Pi has no employees, with all the property management tasks to be performed by other employees from within the group company. There are contracts in place for third parties to provide the cleaning and security services to the commercial tenants. Now he says the total fair value of the houses is similar to the total fair value of the office block. Now that's interesting. The fair value of all the houses put together, that is 10 houses, is equal to the fair value of the office blocks. The directors wish to apply the optional concentration test to determine whether Pi is not a business. Discuss whether Pi constitutes a business or not. Now, I think we could just have a little read on the basic facts again. I'll start my analysis on this. So I think I'm just going to connect the dots once again very quickly. So you can see the company has got 100% stake and they've got 10 residential houses. They've got 2 multi-office stocks. No employees have been taken over. Everything has been outsourced to third parties, whether it is cleaning or whether it is security services. The fair value of those 10 houses and the fair value of those 2 office blocks are of equal fair value. And the management wants to apply the optional concentration test. And then depending upon it, we'll apply the 3-element test. So let's get your results. What do you say? Do you think the optional concentration test will pass or fail? Do you think the optional concentration test is going to pass or fail in this case? Let's get your results. And I think I got the answer. It will pass. It will pass. I'm afraid. I don't think so. It will pass in this case. Okay, I think I've got the one answer. It'll fail. No, let's see. Let me, I think, just give you the answer of that particular problem. I think first of all, let's apply the optional concentration test. If I apply the optional concentration test, let me first organize the data. Now, in this particular case, when I say optional concentration test, the first thing is which asset has got the highest fair value? None of them. If I apply my step number 1, which is the group of similar assets, which is the single asset or a group of similar assets which has got the highest value in this case, So I would say technically there is no asset which has got a highest value because he's given me the fair value of those 10 houses, that is residential houses, it says is equal to the fair value of those 2 office blocks. It is equal to the 2 office block. So there is no asset with a single largest value to begin with. Okay, let's consider that. Let's go to the step number 3. I can't apply the step number 2 because there is no data which is available in terms of the step number 2. I can't calculate my purchase consideration. I can't convert what is the PC which is paid for the assets other than cash. Step 2, no data is given. So I directly come to the step number 3. Can I say this constitutes 50% of the fair value? This concentrates 50% of the face value? So can I say each one represents 50% of the purchase consideration? Since they've got equal fair value, 50% of the value is concentrated in the 10 houses, 50% of the fair value is concentrated in the 2 office blocks. So can I say in this particular case, if I apply the step number 3, the test in this particular case fails. So in this particular case, if the test fails, now tell me, what am I supposed to do? I am now supposed to go to the 3-element test. Since it fails, I will say, okay, let me apply the 3-element test in this case. And let me ask you the very first question itself, that did we acquire the inputs and the processes? He said we've got no employees. He says he's got no employees altogether. So if there are no employees and there are nothing, everything is outsourced to a third party. So did you acquire any input and process? The answer is a no. If the answer is a no, it is supposed to be an asset acquisition in this case. Right? I hope you got my analysis absolutely clear. Because in this particular case, 50% of the value is concentrated in the residential blocks, 50% is concentrated in the office block. So none of the asset has got the highest value in this case. The concentration test will fail, which will push me to the 3-element test. And in terms of the 3-element test, we know that we've not acquired any employee. There are no employees in the company. Everything is outsourced. There are no processes at all. Yes, if you ask me just for understanding the step number 2, that is there an output? Yes, there is an output. The rental which the company is earning, that represents the output in this case. Let's take another one question more. I think that was easy, right? So let's, I think, take you to another question as well. Okay, that's not a problem. That's fine. Let me now share another question to you. Try your inputs in this case. Then I'll maybe take you to a little more technical question also. So I'm sharing another question to you on the screen. Let's have a look at this question now. See the facts of the case. It says Tahini purchases 100% ordinary share capital of Kofta. So in this particular case, the control is there because you've got 100% shares in that company. It says an entity that does not generate revenue. No revenue means that there is no output. It says Kofta operates in the biotech industry. It is engaged in R&D activities into number of drug compounds and also owns a headquarter, research laboratories and a technical equipment. Kofta employs senior management and highly skilled research scientists, and each of the Kofta's asset has got a similar value. We discuss whether Kofta constitutes a business or not. Now we need to understand one thing very important again. The last sentence says each of the asset has got a similar fair value. Can I outrightly say the concentration test will fail? Then I think we'll decide the next course of action. Considering that each of the asset has got a same fair value, so we can definitely conclude that the concentration test in this case fails. That's right. Now we go on to the 3-element test. Now it very clearly tells me that there is no revenue. So can I say if there is no revenue, how many parameters do you need to test? We go to the step number 3. And in terms of the step number 3, how many conditions do we apply? There is only one block with a total of 3 conditions in this case. Let's put the first question. Now for this, we need to understand. The company is operating in a biotech industry and it is engaged in R&D into a number of drug compounds. The company is into research and development. Now, in this particular case, they've got research laboratories, they've got technical equipment. So for the purpose of R&D, you need these kind of inputs as well. Laboratories, technical equipment, senior management, and highly skilled research scientists. Let's put the 3 questions. Do you think the processes are critical in this case? I think yes. Number two, do you think we've acquired organized workforce, the scientists? Number two, yes. Do you think we've acquired other inputs also, like, for example, the research laboratory, like, for example, the technical equipment, with the help of which we will decide that, yes, all the three conditions are met? So, can I say it becomes a business in this case? Yes. Okay, that's great. So, I think we've decided in this particular case that it is undoubtedly a business. I think we got correct answers now this time. It is undoubtedly a business. Let me still pen it down as you will revise. So in this particular case, if I look at my second example, I look at first of all the optional concentration test. I look at the optional concentration test. Now, when I look at the optional concentration test, I think since the data in terms of the numerical figures is not given, I can directly apply my step number 3 and we can say since the fair value of each asset is equal, since the fair value of each asset is equal, so in this particular case, we can say the optional concentration test will definitely fail, because there is no asset which has got the highest fair value and where the consideration is going to be concentrated. So this will fail. Once this fails, then we go to the 3-element or the IPO test. And in this particular case, we put across the question number 1, and that is, did we acquire input and a process? I would say yes. The inputs are in terms of the research laboratories, in terms of the technical equipment, and also you can say the skilled research scientists, their inputs, and the processes, of course, are, you can say, the research scientists. So we can say, did we acquire them? Yes. We go to the step number 2, that is there an output? So we're saying that is there an output in this particular case? And I think if I look at the output, in this particular case, it very clearly says, no, we are not generating output. So there is no revenue. There is no revenue. So there is no output. So even if there is no output, we get a little more stringent. And we've got 3 conditions to evaluate. And the 3 conditions to evaluate is the process supposed to be critical? I would say yes. Did you acquire the organized workforce? I would say yes. Because in this particular case, the research scientists are the organized workforce. And did you acquire the other inputs like the research laboratories and the equipments? Yes. So in this particular case, once you conclude this to be a yes, we can say it is definitely a business. It is definitely a business combination in this case. Wow. You want me to do one more case study on this, or is this good enough to understand the concept of the 3-element test, or you want me to do one more question? I can maybe take one question, which is an interesting case study released by the standard setters themselves in terms of deciding the elements of 3 elements. So let's see, if you want me to do one more, I'll do one more question as well. Let me just check. Yes, one more. Okay, if you ask for, let's give you one more case study on this. Just give me a second then. I'll share another case study. Okay, so I'm just going to take you back. Just a second. Okay, here goes the case study for you. I'll just share it on the screen once again. So let's give you an interesting one. This was a case study released by the standard setters. So this is going to be interesting. Hard question. Well, this is given by the standard setters, so let's see it's hard or not. Let's, I think, have a look at this case study. Let me read the inputs to you. It says an entity S sells its radio broadcasting assets to another entity R. The acquired set of activities and the assets sold comprise the broadcasting license, the broadcasting equipment, and a broadcasting studio. Now, as you read the word broadcasting, suddenly what comes to the mind is that you might start thinking that this is a case of a group of similar assets. No, they are not. Because in this particular case, you're looking at number one, a license which is intangible. You're looking at an equipment and a studio. Even if you want to group the similar assets, what is important in this case is that they should have the same nature. And I think in this particular case, neither the license nor the studio nor the equipment in this case would, I guess, fulfill the parameters of being, something which is similar in nature. So I don't think so we can club these assets in any case. Then he says at the acquisition date, the fair value of each of the assets sold is considered similar. Can I outrightly say that the concentration test will definitely fail? I think on that particular statement, I think you'll easily agree with me on that agenda, and I think that is rightly agreed. Makes complete sense. And then it says no processes needed to broadcast the radio shows are sold. There are no employees or other assets, activities, or processes included. I guess the three-element test will also fail. I think in the very first step itself, I'll end up saying that in this particular case, only inputs acquired and no processes acquired. Then he says entity S has stopped using the acquired set of activities and the assets before the date they sold to R. Identify if the transaction is an asset acquisition or a business acquisition in case the entity decides to apply the optional concentration test. I don't think so. I need to give you explanations. I think you can already decide that this is definitely asset acquisition. Concentration test will fail, and you can say the three-element test, there is no processes acquired. So undoubtedly, it is an asset acquisition. I think I'm not even documenting this part, I guess. Correct. Okay, so this is done. Now let me come back on the special issues. What we are doing today is just creating a platform in terms of entering Ind AS 103. So far, what we have done, we've just tried to enter into the ambit of 103. We've not even started 103 actually, if you ask me, because I'm yet to expose you that what Ind AS 103 is talking of. We are basically understanding that when do you come into the ambit of this particular standard. Now, let me just come back and connect some dots. We started a journey with a three-step model where we said, number one, you acquire group of assets. Then we said, number two, identify it's a business. Now we've seen both the elements, both the test in terms of business. We've seen the concentration test with a three-step. We've taken the IPO or the three-element test with a three-step. So we decided, how do you decide it's a business? Now, there is a special issue in step two that if it is not a business, though you acquired a group of assets, then what is the accounting treatment? We'll go to that. And then in step number three, when you say that there is a control assessment, we'll see in detail when we come to Ind AS 110. As of now, we said the moment you say that you acquire more than 50% stake, we're indirectly assuming that there is a control. Now, I've got two special issues of discussions. One, that if you acquire a group of asset which is not a business, how do you tackle the accounting for that? The second special issue which I said was regarding the distinction. How does asset acquisition accounting and a business acquisition accounting differs? What is the basic difference between the two accounting? So let me first take you back on the study material. And there is an illustration number one, which is given in the study mat. which explains the concept of accounting treatment for a group of assets which is not a business. So here goes the illustration number 1. I hope, friends, that is visible. You can see the illustration. So let me just read the facts of the case out here. Illustration 1 in the study mat. It says entity acquires an equipment and a patent. So when you say equipment and a patent, it definitely means more than one. It would mean group of assets. It says in exchange for 1,000 crores of cash and land. The fair value of the land is 400 crores and the carrying value is 100 crores. So we acquired equipment and a patent. We paid 1,000 crores in cash and we gave a land. The fair value of the land is 400 crores. Then he says the fair value of the equipment and the patent is 505,000 crores. The equipment and patent relates to a product that has just recently been commercialized. The market for this product is still developing. Assume that the entity incurred no transaction cost. For the ease of convenience, the tax consequences on the gains have been ignored. Show how would the transaction be accounted for. Now, in this particular case, when it says the market is still developing, I think we're not given enough data to decide whether it's a business or not. But one thing is very clear, that if I apply the concept of, let's say, an optional concentration test, I think in this particular case, the equipment and the patent has got a value of 500 and 1,000 crore. So what do you say? The concentration test will pass, or do you think it'll fail? 500 by 1500, it's like 1/3 and 2/3, 33% and 67%. So do you think the concentration test in this case is going to pass, or is this going to fail? I think you can easily decide that's right. So we can say that if I were to apply the concentration test, it will definitely fail, because if you consider the fair value of the two assets, 500 and 1,000 crores, I think it does not come anywhere close to substantial. Okay, then if I look at the 3-element test, in this particular case, when it says the market for this product is still developing, so I assume that there is no revenue. But in this particular case, I don't see that I've acquired any kind of processes. So even in terms of the 3-element test, what do you say? Is it going to pass, or is this going to fail? In terms of the 3-element test also, can I say it'll undoubtedly fail in this particular case? Correct. Now let's read the input. It says the standard does not apply to the acquisition of an asset or a group of assets that does not constitute a business. In such cases, acquirer identifies and recognizes the individual identifiable assets. I'm leaving the brackets. The cost of the group is allocated to the individual assets and liability on the basis of relative fair value. If you remember, when I gave you the notes initially, I said the allocation is done in the ratio of fair value. I intentionally did not write the word relative fair value because I didn't want to complicate things at that stage. So let me do one thing before I continue. Let's make a little changes out there, because I gave you the inputs in terms of this. So this was on the relative fair value. So let's come back on the agenda. Yes, so where we said no, and we said in this case step number 2. So we said split the consolidated amount between the various assets in the ratio of fair value. So I think now what you can do, write down it is the ratio of relative fair value. Now you will ask me, what do you mean by a relative fair value? No worries, I'll explain that. But first make a changes. This will be in the ratio of relative fair value. Now what is a relative fair value? If you remember the concept in terms of Ind AS 36, if you've done the concept of allocating the corporate assets to CGU, I don't know if you've done Ind AS 36, I think yes. So if you've done the concept of Ind AS 36, even the corporate assets are allocated in the ratio of relative fair value. In the sense, The assets may not have equal life. The useful life of the assets might be different. So if the useful life is different, you need to convert the value by considering the life is same. I'll give you a very simple example to illustrate this. Let's say, for example, you've got asset A and B, and let's say the fair value of A is 200 crores and the value of B is 150 crores. And let's say the life of this asset is, let's say, 20 years and the life of this asset is 10 years. Just giving you a simple example to understand the concept of relative fair value. So let's say you acquire two assets. A has got a fair value 200 with a life of 20 and B has got a life of 10 years with a fair value 150. Now what you can do? What you can do in this particular case is, if you take a 200 crores with a 20 years life, the product is 4,000. If I convert this into a life of 10, we can say it is as good as 400 with a life of 10. I just took a product. I said 200 crores with a life of 20 years, the product is 4,000. So if you convert this into 10, 200 with a life of 20 is as good as 400 with a life of 10. So the relative fair value ratio in this case is 400 is to 150. This is called relative fair value. So if the assets acquired have got a different life, you need to convert them in accordance with the same life. So that's the reason I made the rectification that we will split the consolidated amount between the various assets in the ratio of relative fair value. I hope I made my point. Let's, I think, come back on the agenda. Let's come back on the example. So it says the cost of the group will be allocated on the basis of relative fair values on the date of purchase. Such a transaction will not give rise to goodwill. And I'm just coming a little below. Now let me ask you something. In this particular case, what is the consideration? Because you paid the consideration in kind and you paid the consideration in cash. In order to acquire the patents and equipment, you paid 1,000 crores in cash and you paid land. Now you need to apply the principles in terms of Ind AS 16. Sir, Ind AS 16, exchange transaction, because you're acquiring assets by giving an assets in exchange. So what do you consider? Do you consider the fair value of the assets given? Or do you consider the fair value of the assets acquired? Tell me. In this particular case, I am given the fair value of what is acquired and I'm also given the fair value of the land in this particular case. The standard Ind AS 16 clearly tells you that you need to consider the fair value of the asset given. I have given a land whose fair value is 400. So I paid 1,000 crores of cash. That is one. I paid 400 crores of land fair value. So my total consideration paid is 1,400 crores. That's right, the fair value of the asset given. So in this case, we come to the point, the fair value of the consideration given is 1,400 crores, 1,000 crores of cash and 400 crores of fair value of the land. It is allocated in the ratio of relative fair values. So in this particular case, we know that this 1,400 crores is divided in the ratio of 500 and 1,000. So that is how it stands divided, 467 and 933. So that amount which is 1,400 crores is divided in the relative fair value ratio. And this transaction will not give rise to any goodwill. So I think let me just make some small note on this point as well. Special issue, group of asset is not a business. How do we tackle this? Let me just add a note out here. So I'm putting this as a special issue number 1. So we're taking this as a special issue number 1. That is group of assets. Group of assets, not a business. Group of asset is not a business. Then how does the accounting in this case takes place? So when you say group of asset is not a business, in this particular case, we can say the total consideration, if I relate this example, we can say the cash plus the fair value of land So in this particular case, the cash is 1,000 crore. The fair value of the land is 400 crores. So the total consideration is 1,400 crores. So this total consideration is allocated to individual assets, is allocated to the individual assets. In this case, the individual assets are equipment and patent. So this is equipment as well as patent. And this is in the ratio of relative fair value. This is in the ratio of relative fair value. So when I say relative fair value, just to put it across, the concept of relative fair value means incorporating the differences in life, incorporating differences in useful life. So incorporating the differences in the useful life of the assets. So any differences will be incorporated and you get the relative fair value. And let me just put a small note further. And in this particular case, we can say no goodwill arises. No goodwill arises in this particular case. Let's also give you a journal entry in this case. To make it conceptually very clear, let me also give you a journal entry as well. So let me do one thing. Let's go back and let's, I think, look at the entry as well. So can I say in this case, you acquired an equipment, equipment gets a debit, patent gets a debit, and we've already allocated equipment is going to be 467 crores. Patent is 933 crores, and we paid cash that is to the extent of 1,000 crores, and the land is going to be given a credit, not at the fair value. The land is going to be given a credit at the book value. So there is going to be a difference of 300 crores. Can I say that will be taken in the P&L? And that's also what it says. There will be a gain. So this gain which is arising, because you can say it's an exchange of the asset. So this gain which is arising on the exchange of the asset goes in the P&L. Effectively, this is being accounted under the guidance of 103 and Ind AS 16. That makes it great. So this is one special issue done. So I've given you one special issue, that is asset acquisition. That is a case of group of asset which does not constitute a business. The consideration which is paid has to be allocated in the ratio of relative fair value. So you need to be very clear on the concept of what is a relative fair value, where you need to incorporate the different lives of those assets and then get the ratio which I showed you previously. Right, friends? I guess this special issue is clear. Now we can go on to the next agenda with you. So now I've got the second special issue, which is also very well addressed in the study mat. And this is what kind of accounting, where is the difference in accounting in terms of asset and a business combination is concerned. Without getting into too much details on this area, because some differences we may not be able to appreciate too much at this stage. So I'll just give you some broad differences at this stage without getting into technicalities. So we now just need to understand the special issue number 2. So let me, I think, pinpoint. We're working on the special issue number 2. So as you're going to revise these inputs today, friends, you know how you're going to revise things. In this case, the 3-step model, which tells you which standards would apply. And then within the step 2, the concentration test, 3-step model. Then the 3-element test, 3-step model. Then we've got 2 special issues. One is group of asset, not a business, how the allocation gets taken care. Second special issue, what is the difference between that once you zero down, it's an asset acquisition or it is a business? How does the accounting differ? Which I'm going to give you some broad differences without getting into technicalities, because some differences you will be able to appreciate once we have done more aspects of 103. So there is a wonderful, interesting chart which is given in the study material, which explains the concept. So I'm just giving you a few differences, not all the differences. So I'm just giving you quick differences as of now. Because some differences you will be able to understand. Like the first one which is given, you'll be able to understand this only once we are done with a few more aspects of 103. But I think let's give you one thing. The first difference is in a business combination, goodwill gets recognized. And in terms of acquisition of assets, there is no goodwill. So there is one area of difference. Business combination will result in a goodwill, but if it is an asset acquisition, no goodwill. Second difference. TC. If it is a business combination, then the acquisition cost is expensed in the period in which it is incurred. But in terms of asset acquisition, it gets capitalized. So let's say, for example, if you're acquiring a land and you're paying some kind of brokerage commission, all that will get capitalized as a part of the cost of the asset. But any transaction cost which is paid on account of business combination, that is simply expensed. That is second key difference. Then I'm coming to the third difference, and that is deferred tax accounting. The moment you go for a business combination Ind AS 103, you will see that there will be a deferred tax implications as well. We'll very soon come to those inputs as well. So deferred taxes are recorded and temporary differences are captured. So you can say the application of Ind AS 12 will come into play. But once it is a case of asset acquisitions, in this particular case, Ind AS 12 prohibits the recognition of deferred taxes for this particular case. And of course, there are some inputs related to Ind AS 12 which you might recall. Initial recognition of asset and liability, which is not a business combination. So there are cases where there will be no application of deferred tax per se. Okay, and then this particular case we'll come to later. But okay, these two I think we'll be able to understand later once we understand more nitty-gritties on the standard. So I would say three core areas of accounting. If at least somebody tells you that what is a difference between asset and a business combination accounting, at least we can pen down three broader differences. So if it is a business combination and if it is an asset acquisition, so you can pen down your thoughts in terms of three broad areas of differences. One is in terms of goodwill. Business combination leads to goodwill. Asset acquisition does not lead to goodwill. The second is a deferred tax. Business combination leads to deferred tax. Asset would not lead to, you can say, deferred tax. And third is the TC. Business combination, it gets expensed in the P&L. And in this case, it gets capitalized as a part of the cost of the asset. So these are the three broad, you can say, differences between a business combination and asset accounting. Now, let me also tell you, therefore, it becomes even more imperative that, one has to very carefully decide that a given situation is an asset acquisition or a business combination. That was on the special issue number 2. So my three-step model done, and within which the business test, that is concentration, and the three element test done, and the two special issues done. We made our backgrounds in terms of Ind AS 103. I will now say, welcome to the world of consolidation standards. Right, friends, I think that seems to be all good for the day. Unless you've got questions to ask, please do revise all this, because we'll start a grounding work in terms of what we call acquisition accounting. Because once Ind AS 103 becomes applicable, it triggers the concept of what we call acquisition accounting. Thank you very much. So what is the logic of expensing of the TC in terms of business combination? Well, once we learn the aspects of acquisition accounting, I'll get into the details of purchase consideration. Then you'll get more, detailed logics of that, because I'm going to explain the entire acquisition accounting in a 7-step model. So once we start working on that, you'll definitely get more insights on that. So you'll have to probably wait for some time on that. Correct. Right, friends. So thank you very much indeed. So time to say goodbye to you, friends. So we're going to see you in the next class. Thank you very much. Bye-bye and take care. हाँ जी, थैंक यू।